Hello everyone, we are moving forward to Nepal Rastra Bank Directives 2081 and 82, and in this video we are going to describe Directive number 1 of Nepal Rastra Bank Directives, Unified Directives. So the very first directive is Provision on Minimum Capital Fund. So this directive puts forward the minimum capital requirement, which is to be maintained by licensed A, B and C class finance institutions under the authority which is guaranteed by the Nepal Rastra Bank Act 2058 of section 79, and which are as follows. The very first point is minimum capital fund to be maintained. So, Class A and national level Class B licensed finance institutions shall maintain minimum capital fund provision according to Capital Adequacy Framework 2015. Whereas other Class B and Class C finance institutions which are licensed shall maintain minimum capital fund provision according to Capital Adequacy Framework 2007, which was updated in July 2008. Likewise, counter-cyclical buffer shall be 0% for commercial banks, which is effective from 2071 Shravan, and otherwise until Shravan the banks shall maintain such buffer according to Capital Adequacy Framework 2015. The second point is capital fund, and it is similar to the first point where the capital has to be maintained, or capital fund has to be maintained by the finance institutions. So here total capital is the sum of primary, which is tier 1, and secondary tier 2 capital, and Class A and national level Class B licensed finance institutions shall maintain capital fund according to a framework 2015, whereas other Class B and Class C shall maintain according to 2007 updated July 2008. So to explain this, now let's go to the Capital Adequacy Framework 2015. According to Capital Adequacy Framework 2015, capital is the sum of tier 1 and tier 2 capital, and they are tier 1 capital, that is core capital, and the tier 1 capital or core capital consists of common equity tier 1 as well as additional tier 1 capital. The next is tier 2 capital or supplementary capital. So let's know about tier 1 capital, which is core capital. So this core capital comprises of equity capital and disclosed reserves. So in order to be tier 1, the capital must be fully paid up, have no fixed servicing or dividend cost attached to it, and be freely available to absorb losses ahead of general creditors. And it should have a very high degree of permanence if it is to be treated as tier 1. Here, common equity tier 1 or CET1 has the following elements. The very first element is common stock, second is share premium, third is statutory general reserve, fourth is retained earnings available for distribution to shareholders, next unaudited current year cumulative profit after all provisions including staff bonus and taxes, capital redemption reserves, capital adjustment reserves, dividend equalization reserves, other free reserves if any, and regulatory adjustment or deductions applied in the calculation of common equity tier 1 capital are deducted. Next is additional tier 1 capital AT1, and the additional tier 1 capital consists of perpetual non-cumulative preference share PNCPS and perpetual debt instrument PDI. Similarly, stock surplus or share premium resulting from the issue of PNCPS instrument less regulatory adjustment or deduction applied. So, what items are deducted from the core capital or tier 1 capital? So, banks shall be required to deduct the following from the common equity tier 1 capital for capital adequacy purpose. So, to calculate the capital adequacy, and following elements shall be deducted from the common equity tier 1 capital. And the very first is book value of goodwill and all other intangible assets. Similarly, the second is deferred tax assets. The next is miscellaneous expenditure to the extent not written off. Next, investment in securities of finance institutions, which is licensed by Nepal Rastra Bank. All the investment in equity of institution with financial interest. Investments in equity of institution in excess of the prescribed limits. Investments arising out of underwriting commitment that have not been disposed within a year from the date of commitment. Similarly, reciprocal cross holdings of bank capital artificially designed to inflate the capital position of bank. Now, the tier 2 capital or supplementary capital consists of the given elements, and they are redeemable non-cumulative preference share RNCPS or redeemable cumulative preference shares RCPS, which is issued by the bank with the maturity of 5 years or above. Subordinated term debt fully paid up with a maturity of 5 years or above. Similarly, hybrid capital instruments, general no loss provision limited to a maximum of 1.25% of total credit risk weighted exposures, exchange equalization reserve, investment adjustment reserves. Similarly, revaluation reserves and any other type of instruments which is notified by Nepal Rastra Bank from time to time for inclusion in tier 2 capital, and the deductions are same accordingly. So here capital ratios are computed. So computation of capital ratios is given here, like common equity tier 1 capital ratio is calculated as common equity tier 1 capital divided by total risk weighted exposure. Similarly, tier 1 capital ratio is eligible tier 1 capital divided by total risk weighted exposure. Capital adequacy ratio is the eligible total capital divided by total risk weighted exposure. And total risk weighted exposure is the summation of credit risk weighted exposure plus market risk weighted exposure, operational risk weighted exposure, supervisory adjustment under pillar 2nd of Basel 3rd. And risk weighted exposure is the total risk adjusted value of bank's assets. For example, value of assets into risk weight. In this way, RW is calculated. So now, according to Capital Adequacy Framework 2015, minimum common equity capital ratio is 4.5%. Similarly, capital conservation buffer is 2.5. Minimum tier 1 capital is 6, excluding the conservation buffer, and minimum total capital is 11, including conservation buffer. These are all in percentage. And yes, counter cyclical buffer is 0 to 2.5%. So now let also understand Capital Adequacy Framework 2007, updated July 2008. In this also, the capital fund is the summation of tier 1 and tier 2 capital. It doesn't have common equity tier 1 and additional tier 1 capital, but tier 1 capital consists of paid up equity capital, irredeemable non-cumulative preference shares which are fully paid up, share premium as like before, proposed bonus equity share, this is the new term here, statutory general reserve, similar as before, retained earnings available for distribution to shareholders, unaudited current year cumulative profit after all provisions including staff bonus and taxes, capital redemption reserves created in lieu of redeemable instrument, capital adjustment reserves created in respect of increasing the capital base of the bank, dividend equalization reserves, and any other types of levers notified by NRB from time to time to include in tier 1 capital. There are also deductions from the core tier 1 capital, and such deductions are book value of goodwill, miscellaneous expenditures to the extent not written off, Similarly, investment in equity of finance institutions, which is licensed by Nepal Rastra Bank. All investment in equity institution with financial interest. Investments in equity of institutions in excess of prescribed limits. These are all very same uh, as to Capital Adequacy Framework 2015. Investment arising out of underwriting commitments, reciprocal cross holdings, and any other items as stipulated by the Nepal Rastra Bank from time to time. And yes, tied to capital or supplementary capital consists of cumulative or redeemable preference share with maturity of 5 years and more, subordinated term debt fully paid up with a maturity of more than 5 years, hybrid capital instruments, general loan loss provision limited to a maximum of 1.25% of the total risk weighted exposures, exchange equalization reserves, investment adjustment reserves, revaluation reserves, and any other types of reserves. And here, the capital ratios are computed as Tier 1 capital ratio, which is the ratio of eligible Tier 1 capital and total risk weighted exposure. Similarly, capital adequacy ratio is the eligible regulatory capital or total capital divided by total risk weighted exposure. And here, here total risk weighted exposure is the summation of only credit, operational, and market risk weighted exposure. So, so in Capital Adequacy Framework 2007, which is updated in July 2008, minimum Tier 1 capital required is 6% and minimum total capital required is 10%. So it is slightly different from the framework of 2015. So now we understand the minimum provision of capital fund to be maintained and the buffer according to both framework 2015 and 2007. So third point is in the directive. Third point is details to be submitted regarding capital fund. So licensed bank and finance institutions must maintain the required minimum capital adequacy ratio at any time as prescribed. Next, licensed bank and finance institutions must prepare the capital fund statement in the prescribed format based on financial statement at the end of each month, have it certified by the internal auditor and submit it through the bank's reporting portal within 7 days of the end of each month. Similarly, next directive is regarding the ICAAP guidance, that is Internal Capital Adequacy Assessment Process Guidelines. So, licensed bank and finance institution must comply with such guidelines issued by Nepal Rastra Bank. Next is regarding audit. If the bank deems necessary to obtain business information from banks and finance institutions which are not having sufficient capital, it may conduct a due diligence audit, and the expenses incurred for this purpose will have to be paid by the concerned institution itself. The next is the actions to be taken towards non-compliance with capital fund directives. So, if capital fund directives are not complied with, corrective actions will be taken according to the Prompt Corrective Action Regulations 2074. And in case licensed bank and finance institution fail to maintain capital adequacy ratio at a particular period within a fiscal year, but it was able to maintain the ratio at the end of the fiscal year, even then the cash dividend and the bonus share shall not be allowed to be distributed. And the last is repeal and saving. Provisions related to the capital adequacy in the Unified Directives 2080. The directive issued from Directive number 1080 and all circulars relating to this matter issued until the end of POS. These all are to be repealed. So this is all about directive number 1.